The big thing that a lot of founders need to realize is,
what are the signals that you're looking for from those brand owners that make them a good fit for an acquisition?
top 3 things. Money is not sloshing around like it's growing on trees. I think it's going to get tougher for a brand over the next 6 to 12 months. And it's definitely not the rosy picture from 4 years ago. But deals are getting done, money's starting to flow through the system, and it feels like everybody is kind of adjusted to what reality now is. The 3 key financial statements, I think is really important. Don't squeeze all of the juice out of the orange. I see this mistake a lot where people try to juice their stats or they try to get a little bit more revenue. We don't want to buy something that's about to die and that, we need to go throw out and rebuild. There's got to be a good, clean narrative.
Jeremy, welcome to the DTC Podcast. Excited to have you here to discuss PE in the e-commerce world. Start by telling me a little bit about your hero's journey and what brought you to founding Because Ventures.
Yeah, thank you for having me on, Eric. I basically spent actually my entire career in e-commerce. So the super short version, because I hate talking about myself, I started building Magento connections back in the day, if anybody remembers what those things are. It's basically Shopify apps before Shopify was a thing. Actually got into the Shopify ecosystem working at a dev agency in New York City, migrating WooCommerce brands over to Shopify. And there met a company called Lumi. They were a client, which I ended up going to work for full-time for a couple of years after that. Really high level, 8-figure Shopify Plus brand, very early Shopify Plus brand that sold Kim Kardashian's favorite selfie case. So you have a cell phone case with light rails on it. Now it's, what everybody uses for podcasts and recordings. But at the time, take a photo of yourself, your friends, your food when you go out, post it to social media. Joined full-time, transitioned from the agency to full-time there when we were going from about 7-8 figures D2C to high 8 figures, massive retail expansion, Verizon, Sprint, Target, Best Buy, Apple, a lot of your major retailers. Worked there for a couple of years, then joined my partner who had acquired an automotive aftermarkets business. There, well, he had acquired it. We were scaling that from 6 to 8 figures. And then we started building software to solve our own problems, spun those out into individual SaaS, late 2018, 2019. All 3 of those businesses exit at the same time. My partner basically retires. I go to work for the SaaS side of the industry. So we're starting to look at deals again. We took a little bit of time off. He wanted to go on vacation for once in probably a decade. And then we started looking at some early stage deals. And then we started looking at, hey, we really want to go back and operate. So at my day job, I was at Dacity, which is a Shopify Plus app, and then Gorgeous, where we were looking at a bunch of deals. What could we acquire? What could we go, recreate that playbook, acquire a brand, scale it up, figure out what software we could use to solve the problems that brand had. Year ago, I leave Gorgeous to do that full time, and then spent about that 4-year process, probably looked at almost 400 deals, pretty close. And then we made our first acquisition, which was Coco.ai, which is a Shopify app. We closed that in February, now operating that. And we're still in talks and looking to acquire that first platform brand or that first big brand that we're going to base the whole fund off of.
Very cool. I want to dive into Coco a bit later, but talk to me first about the macro environment right now for brands looking to be acquired, looking for investment. What's going on now versus 3 years ago, and how's the outlook?
Yeah, money is not sloshing around like it's growing on trees. I would say that fundraising and exits in general in 2020, 2021, 2022, once you got past that first initial, oh my God, COVID's going to ruin the e-commerce industry, and then it boomed, was just amazing. If you got money in or if you sold your business at the time, enjoy the island that you're living on. I would say when that market corrected 2022, 2023, it got really, really hard. So one important thing to think of, when someone like us, a private equity firm, comes and buys a business, is we're doing it with a combination of equity and debt. Interest rates are sky high, means that our costs to buy your business is way, way higher, right? Especially if you go from 3 to 6, your business, same as your house. Literally a business just became 2 times more expensive for us to acquire. And our LPs on the equity side are who we are investors, who we get money from, aren't as excited when they see their stock market, their public holdings and all their other investments get pulled down. So they get a lot more judicious. So I'd say 2022, 2023, the markets kind of froze. It was this really weird spot where everybody was a little hungover from the absolute heyday of 2020 to 2022. And we didn't really know what the market was. I would say that the market in the past 6 to 9 months has really opened back up again. And I think that's a combination of 2 things. The first one is I think founders have a more realistic expectation. They don't have those 2021 highs of, especially for brands, thinking that they're going to get a lot of multiples on their revenue versus their profit or what we call EBITDA. I think the second piece is despite the current political environment in some capacities there, I think a lot of people on our side are itching to get deals done. We don't make money unless we buy businesses and then have some sort of liquidity event on the other side. And so it feels like the market's coming back to a better place where everybody's kind of meeting back at that zone of what's a reasonable expectation for a brand to exit. And just for context, we operate in the 10 million in top line to 100 million in top line. So we're not looking at mega deals. We're not looking at, the Poppies to PepsiCos. That's kind of the exit after the exit from where we operate. But in that kind of SMB lower mid-market range is, I would say those two real factors are going where we've seen a tale of two cities to wrap up the point and to answer your question. You have these mega exits that are looking amazing. Poppy, I'm sure I'm not pronouncing this brand right, but Siete. And then you have like Stuart Weitzman getting dumped, Pura Vida being sold for $1 million after a $50 million acquisition a couple years ago, where like everybody kind of seems to be like, okay, we need to get things done. We're going to either clean up house, have the massive exit and move on. And so I think it's going to get tougher for a brand over the next 6 to 12 months. And it's definitely not the rosy picture from 4 years ago, but deals are getting done, money's starting to flow through the system, and it feels like everybody is kind of adjusted to what reality now is.
And e-commerce is not going anywhere. It may not grow at the pace it was growing in those early COVID days, but it's going to continue to grow globally, right? So it's still easy to be somewhat bullish on it.
Yeah, so for context, I am mega bullish on e-commerce. Like if you take the macro picture, pre-COVID, we went from like 15% of the US economy was run through e-commerce, and now we're at like 20. And yeah, it went like the graph of the adoption went vertical for about a year, plummeted. But if you now zoom out to 5 years, it basically is just a straight line up. Like it mean reverted. It just went to the average, and we still have the same growth. And so if you just think about, however you want to picture the global economy, e-commerce is only, and this is ridiculous to say out loud, e-commerce is only $6 trillion. And so it's a massive, massive market already, but it's going to continue to grow. Who knows if over 2 decades it becomes 50% of the global economy, 80% of the global economy. I think that's probably a little ridiculous. But even if it goes from 20 to 25, we're probably talking about $8 or $10 trillion. And so like there's this massive growth still to be had. And I actually probably a completely different topic for a different podcast. I have this whole like map of how I think Shopify is going to become one of the next $1 trillion brands over the next decade.
So I should keep my stock. This is not stock advice.
Yeah, this is not stock legal financial investing advice. I was never here. But yeah, I'm a pretty big believer that
I love it.
You're going to see e-commerce just take a very, very long tail up. And it's definitely getting harder to have a great brand, but there's still so much more growth to be had.
I love it. I discovered you guys from a post that you made, I think about a year ago now, but it was basically about how PE could essentially save a brand like Tupperware in a turnaround. So I don't know if you want to reference that post specifically, but walk us through the role of PE in a brand right now that's treading water or maybe not doing as well as it should.
Yeah. So for everyone who's listening who isn't familiar with my content, what Eric is referencing is every Sunday I have a newsletter called Let's Buy a Business where I take a public company, go through show you all their financials, and then basically what's my 3-step turnaround plan. And so this was either right before or right after Tupperware had said, given their public warning, that's like, hey, we're not sure we're going to make it out the year. And so I think, PE gets generally a bad rap, and there definitely are bad players in that space, like there are bad players in every space. But physical consumer, I think the great myth that a lot of brands believe over the past decade is that VC is actually a good investment vehicle for a DTC or a physical products brand. And it's actually terrible. And we can go into why. And, I did it. I wrote 10 early stage checks into brands. So I was that person. I made that mistake. And we can go into why and the components. But if you look at most of the truly successful, massive, and I mean massive brands, Yeti, Aesop, they were actually PE funded. And usually when a brand like Tupperware, so the reason Tupperware went bankrupt is they had $1 billion in sales. The problem was that they flipped from like a sub 20 million profit for the year to a negative profit when they had $700 million in debt on their balance sheet. And so at that point, it's a great brand. I would honestly consider it, and one of the reasons I was like very passionate about that specific post is I consider it to be an iconic American brand.
Yeah.
Like I consider
it's
that
one
to
of
be
those brands that you call other products, even if it's like Kleenex, right?
Exactly.
Like you're not, instead of tissue, you say, hey, hand me that Tupperware, even if it's not Tupperware.
Yes, I don't own a single Tupperware product in my household, and they are all called Tupperware. And so really I want, like, how can we save this brand? How can we turn this around? And that's where a lot of PE is focused on, is either, there's usually two use cases we look at. Things are going amazingly well, and how do we just throw fuel on the fire in a disciplined manner? We don't look for 400x growth year over year. It's 20 to, 100's an amazing year. 20 to 50x is great. Sorry, 20 to 50% is great, because over 5-10 years, that's a considerable amount of growth, and, we can make our math work. The other part is in the turnarounds, and you just need someone who has the two components, the financial literacy and the financial backing to get that brand out of that situation. And I don't know if you follow Drew Sanaki or if everyone's familiar with him, but he posts great content on this as well, because this is most of his career, is like going in and doing the turnarounds. And you need someone who, can you really stretch your cash flow? Can you really figure out all your payment terms? And it's very interesting of like when you study the brands that fail, the same things that they fail, they're actually what makes the great brands great. Like if you're doing well as a brand, one takeaway from this, go renegotiate all your payment terms. And now with like everything that's going on, it's a pretty good time to go do that. And it's really interesting to like dissect, like almost like post-mortem, like what didn't go well. And so you need someone also who can just work with bankers, who can work with the debt providers, because essentially at the end of the day, debt is a great tool and a great lever for physical product brands, especially when you think about, I lay cash out here for inventory, here for marketing, and then I get paid back all the way down here. But you really need to use it carefully. It's fire. It can light your engine or light your house on fire. And so you really need to be careful and have someone who can understand and kind of talk that talk. And if you can really nail those couple of things, it can be a great way where, a brand like Tupperware that should be doing very well, it should be at $1 billion in sales at a 10 to 15% net income margin, really should have that player that can help them navigate those waters. And then, the operators operate the business, go scale it, and figure out how to make that brand as great as it should be.
I want to dive in actually on the reasons why VC isn't a good fit. But before I do, go to letsbuyabiz.xyz. Jeremy's content is great. Follow him on LinkedIn. We were just talking in the pre-show. You're following in the awesome footsteps of creating a media company to help grow your venture fund, which I think is a really smart play. That's what we're doing here at Pilot House. Talk a little bit to me about why VC and D2C are not a match made in heaven.
Okay. And I've done this, so I can tell you, and one or two of them are still working out, but most of them have failed. The problem with a e-commerce business is, when does cash come out? When does cash come back in? And so the VC pitch was amazing. I don't have to give up any debt, which everybody's scared it will kill my business. I can get a lot of cash in now, plow it all through my inventory, spend a bunch of money on marketing, and grow really, really fast. The problem is a physical product brand needs to be incredibly disciplined on their cash flow and their inventory management. Having a ton of money does not make you do those two things very well. And what I saw all of these VC businesses do is they hired way too many people. Like, one of the things I absolutely love about e-commerce, and especially D2C, is you can, a great team of really solid people. I've seen people grow $10 to $50 million brands on 6 people. Everybody's wearing a lot of hats. I'm sure they don't have a lot of vacations and weekends, but they are absolutely crushing it. Like, I can't tell you how many pitch decks in all these other companies I saw that was like $1 million in revenue with 15 to 25 people. And the discipline in picking the right products that have great marketing, that, a couple of really big asymmetric bets, which is actually what, VCs want to see, is really hard to do when you have that much money. So I think that was a first mistake that a lot of brands made. The second one is just, a physical products brand should not be growing 300 to 400% year over year. So for everybody who hasn't raised money, when you get a VC check at the seed or Series A stage, they call it the triple, double, double. And I've lived this twice in the past 5 years, so I'll just quickly walk everyone through it. If you're at $1 million today, the VC writes you a check for, let's say, $1 million. They expect you to triple year 1 into year 2. So let's say you're going from 1 to 3. Then you're going to go from 3 to 9 in your second year. That journey from 1 to 10 million is absolutely awful from a cash flow perspective, from a hiring perspective, from a marketing perspective. Because the one thing where D2C does not work like software is it actually gets more cash intensive the more you grow the business. And then when you need to layer on, at 1 million in revenue, 2 to 3 great people plus a couple agencies, you're even one person plus a couple great agencies, you can be great and you can have a nice profitable business. You could be taking out a couple $100,000 a year and do very well. To get to 5 and to get to 9, that's when you have to start layering on teams and managers and a lot of people to get there where, you go from 1, it sounds like a lot, but to go from 2 to 10 people on a team is a lot. And then when you add in, that's probably somewhere around $500,000 in salaries and OpEx, you just evaporated your profits. Now, the big bet is that you can swing and get to 20, 30. I mean, really what the VC is looking for is $100 to $500 million. And when you just think about how many brands can actually grow to that scale, it's not very many. And the third reason why this doesn't really work or make sense is once you start getting to that scale, you need debt. Like you need to put debt on the business because you probably are in retail. And, we can talk about the awful cash conversion cycle of retail, but marketplaces, right? Amazon doesn't pay you until net 45, net 60. And you need debt to just basically float that inventory purchase, especially if you're shipping stuff from Asia. And, just continually raising more VC isn't going to solve your problem because you're just going to burn through the cash, which then you need to put into, inventory ads, get as much of it back as possible to cycle it all immediately back into inventory and ads. You basically have to just survive the just a little bit bigger ride. And really, that's where you want debt, because debt, you essentially, especially what's called a revolver, it's essentially just a loan from a bank. They say, we'll give you $500,000, million, $10 million, whatever it is. You pull it down, you pay it back, you pull it down again. And that's really what you want, because yes, there's a fee associated to that, but you're not selling probably 80% of your company along that journey, but it also allows you to just basically, especially with the cyclicality of your business, just cycle money back and forth as you grow. And it's scary, and yes, you have to sign covenants, and yes, if things don't go well in either scenario, someone else gets your business. But you can't just keep burning through a stockpile of money, trying to make it all back, trying to put it in, trying to pay it all back. And, at the end of the day, a VC, they need 1 out of 100 to hit to make their return. So, and also your business just candidly isn't that important to them.
That makes sense. Yeah. Talk to me about the golden path here, or the brands that you're looking for, and how it would work with a company like Because.
Yeah. So private equity in general, and I think we take this almost a bit of an extreme, you can't miss. Like private equity, we're going for doubling our investors' money in a 3 to 5, sometimes 7-year timeline. The difference in VC math is I just need 1,000x bet where, if I put in 100, I get back 10 million and I can cover all of my other bets. PE, and for our fund specifically, we are going to buy one brand. Maybe we buy other brands that then, we what's called a roll up or a tuck in, like we essentially merge into that one brand. But we got to be 1 for 1. We cannot be 1 for 10. And so I think that's the biggest difference, is that private equity also has much more realistic expectations on exits. They're not looking for the triple, double in 4 years. They're really much more looking for, okay, if we put X amount of money in, how do we 2X our money in 3 years? And they care greatly about, we care greatly about cash flow and profits and distributions, which if you're the founder of your business and you have never raised money, that should be your goal. An exit is great at the end of the day. Like if you can sell your business and it's worth a lot, that's amazing. But really the value of your business should be in what are called distributions, or essentially leftover profits that you don't have to put back into inventory, marketing, the team, or taxes. And so really aligning, if that's your goal and you're not just completely optimizing for an exit, you really want to align yourself with a partner. Because, if we're splitting a cap table and we own a portion, you own a portion, the bigger the distribution is for everybody, regardless of your ownership, the better it is for everybody as well.
So what are the signals? So we've got, thousands of brand owners who listen to this podcast. So what are you looking for among those? What are the signals that you're looking for from those brand owners that make them a good fit for an acquisition?
We have a whole list of stuff, so I'll try to keep it short. I think, top 3 things, and this depends on whether they're looking for, let's just go with the full exit. I'm done with my business. I'm ready for the next person to take over, and it's been a great ride. the core fundamentals, you have to have really strong unit economics. So gross margins normally over 50%, contribution margins usually somewhere around 30%, and then your net income, literally just, your top line, take every expense out of your business, is usually around 10 to 15%. There have been some what I would call unicorns in this respect that have 25, 30, 40% net income margins, but they're very special businesses. We specifically look for 50% or more DTC businesses just because that's our model. There are people who love majority retail, majority Amazon. And then, if you really want to go like cash a check, go hang out on a beach, really strong team and really strong SOPs and procedures. I think a big mistake I see with a lot of founders in our space is they're like, I do everything. I am the business and I want you to give me the most amount of money possible. And I want to go to a beach tomorrow. And I think the big thing that a lot of founders need to realize is if someone's writing you a check, and the bigger the check, the less they want to do the job. And so I think when I have a lot of talks with a lot of founders who are like considering exiting is, do you want to actually sell your business, or do you just want to hire an operator to run your business and you can kind of step out of the, the grind and the day-to-day and all the sleepless nights? And I think that role should be hired no matter what, because it's called key man risk or key person risk. You lose points on your multiple, which, we could go from a 8 to a 6 to a 5 or 3 based on not having that person. So I would say that's like number 2, absolutely crucial. And then the third part is, we can get into all the specifics, but a really, really well-defined product in an interesting category. I'll probably bite my tongue on this, but I cannot tell you how many clean beauty and yoga pants businesses and athleisure businesses we've seen. And the problem is if you're not differentiated, it's really hard for someone to write a big check into that, because we're just concerned that why is this going to stand out versus the 50 other players in this space? And so having something truly unique that stands out about your business, product is usually really helpful, but it could be the way you go to market, your distribution, intellectual property, something about that's really unique to your business that, a lot of people refer to this as a moat, but I think a moat is a little bit misleading. It's something that's either impossible for someone else to recreate or copy. Like, why can't, one of my partner always loves to say, why can't we copy this in 6 months? And I think if you have a really compelling story and narrative around that specifically, with a really strong team that can take over with really strong unit economics, you're going to do very well when you exit your business.
You've got the added pressure now of all the Chinese sellers on TikTok. Every third video I scroll to on TikTok are the Chinese sellers being like, you can buy Lululemon pants for, $1 plus the tariffs. It's still 100% cheaper. So that's added pressure in the industry, which is just great. So I one of my questions was like, what could a founder do 6 to 12 months in advance to a potential acquisition to improve their valuation? One would be that key man. Make sure that you've got your SOPs. Make sure that you're not the linchpin in your business, because if you want to leave, that's not going to work. Anything else that you'd advise founders to do in advance?
Yeah, I mean, the first piece of advice would be to start 6 to 12 months in advance. I cannot tell you how many people I talk to, and it's like, oh yeah, I want to sell my business in a month. And so having and I mean clean SOPs, I like to pretend that I'm a 7-year-old when I join a new company, and can you train me up on how to do everything? Like that level of very good detail, very simple, there's nothing that's stuck in one person's head. So that'd be crucial. 2 is really clean financials. I know it's expensive to work with a broker or an investment banker or an advisor, but clean up your QuickBooks so that it's understandable. And there are so many templates for e-commerce brands. We have a bunch that I'm happy to share as well on what a good e-commerce P&L looks like, but just really, really simple. Going back a couple of years, the 3 key financial statements, I think is really important. Your P&L, your balance sheet, and your cash flow statements. And if you don't know what those are, I would recommend talking to someone to get some help and advice on building those out, because that will determine so much of the value. A couple of tactical things that you can do. Think about really every single cost in your business, and is it absolutely 100% necessary? Your business will trade for most brands, it will trade on a multiple of their profit. And so if you can take out $100,000 in costs to your business that don't need to continue, a great example of this from one of the brands we looked at last year was they went to naked shipping. They stopped paying for boxes and they stopped wrapping their boxes. And, at a unit margin level, if you want 6 times your profit, if you can add $100,000 back into your profit, that's $600,000 that you'll make in an exit. And so really thinking through those components and those pieces, My one last piece of advice, just because we see this occasionally, is like, don't squeeze all of the juice out of the orange. I see this mistake a lot where people try to juice their stats or they try to get a little bit more revenue, where either they cut their revenue, they cut their advertising completely to make it look more profitable, or they start running a ton of just clearance level discounts to try to just boost sales. We don't want to buy something that's about to die and that, we need to go throw out and rebuild. Like, we want to, there's got to be a good, clean narrative of, this was my part of the journey. I did a great job in XYZ. My strengths were not 1, 2, 3. You should buy this business because of that. And a great example of that is like, I crushed DTC. I'm amazing at meta ads, but I did not want to invest in other channels and email, or I did not want to go into retail, or, it didn't work for us at the time. We didn't have the funding, the structure of the team, whatever the real reasons are. But definitely create a narrative around, this is where the business should go. I've thought about this and I've realized that it's just not a fit for me. That's a really compelling narrative, because then we can go, okay, well, I do know the person that's an expert in getting into CVS and Walmart and Target and whatever. And I do know the person who's amazing at Amazon. And then it's a compelling business for us, because just so you know how private equity works, we have to write a deal memo, which is actually where my newsletter started, is I just basically created public versions of them, where there's a section called EBITDA expansion. In English, all that means is we need to make the business more profitable, because if the business becomes more profitable, we can sell it to whoever we will sell it to down the road so that we can make more money back. And really thinking through clean paths on how the business can become more profitable and grow, and, not ruining it for the next person is also crucial, because you might get some interest seeing, the 100% year-over-year growth or the impressive profits. But when someone looks at your business, you're just going to have kind of what I always call like a bad date. Like, they're going to show a lot of interest, be like, yeah, this is great. They're going to look at your books and be like, oh my God, what is going on? And so really having that clean, I think, like the clean story, really thinking through your narrative. You spend so much time optimizing the sales pitch on the way up. Really have a clean narrative on the way out, as well as like, this was perfect for me. I have a family event. I have this. Candidly, I honestly hear a lot of just like, I'm bored and I'm ready to move on to the next thing. And just really make sure you have that wrapped up so that it's a very clean story for us, because we just do the same thing. We go to our investors, we pitch them, we say, hey, this is a great idea because of XYZ. We want to buy this business because of 1, 2, 3. And then, the story needs to make sense clean throughout and give us enough confidence, if you want a multi-million-dollar, $100 million check, that everybody in the chain feels comfortable writing it.
The power of the story is something I hear again and again on this podcast, whether you're marketing, exiting, building, everything.
It's all a narrative.
Yeah, it's all we're all storytellers. You mentioned 50% D2C, and I love to hear that, because it's like, this is the D2C podcast, but everyone at some stage wants to be omni-channel. You also mentioned the terrible cash conversion cycles in retail. Maybe a bit on that. And also, are there any other benchmarks in terms of like AOVs or retention rates or things like that you're looking for that make great businesses?
So other than the P&L benchmarks, I think, so the 50% D2C thing is purely just us. That's our area of expertise. That's our zone of genius, where, we can take a brand that does that, layer on the other components. And then also part of the reason why is the people who would buy businesses from us, they're retail experts. Like, we kind of like, our narrative is also, we took it from here, we added these layers on, and then, it's ready for the next person, and we're not going to be the best fit when, you got to go into 10,000 doors across the country. As far as benchmarks, I think, there are kind of these standards by industry, and I think it's really important to know just generally what your industry is. That's actually where I started a lot of this, like, tearing up public companies, is I would constantly look for comps, and I would constantly look for examples of, what does a standard beauty P&L look like versus a great example, right? Beauty versus food and bev, or CPG, what most people typically refer to, right? Beauty probably gonna have 80% gross margins, right? Beauty is 90% packaging. The liquid inside of it's really not that expensive. So you usually have very, very high gross margins, but then your marketing spend is a massive portion. 20, 30, 40% of your revenue goes to marketing. Whereas food and bev, usually very, very low gross margin, like 40%. Much lower marketing spend because, you don't have the other 40% to spend on marketing. And so I would say there's a lot of great resources out there. I've posted a lot about this, as well as like, figure out more of what the standards are in your industry and try to beat them. Like, you should not, I wouldn't say you shouldn't. It's very, if you're a food and bev business trying to shoot, you're at 40 and you're trying to shoot for 80, that's the completely wrong thing to focus on, right? Like, you should work within the constraints of your business. But really what it mostly comes down to is the metrics on your P&L. Like how much does it cost you to acquire acquire a customer? How many times do they come back to purchase? I think the other misleading thing that a lot of people read in the Shopify dashboard is they read repeat purchase and think of what percentage of my revenue is coming from returning customers. We honestly don't really care that much about that. What we actually want to see is, do you have a one and done problem? And what we're really looking for is what's called the repurchase rate, which is what percentage of the customers, like the humans, come back to buy and how often do they? Because what you, as a brand owner, what you should also be thinking about is, what's my CAC payback period? I spend $10 in marketing today. How long does it take me in gross margin to make that dollar back into my business? Essentially, what's your return on your dollars invested in marketing? And then we want to know, how much money are we going to make on the back end, so that if we do say, hey, you're spending 10, well, that's very outdated. You're spending 30, we want to go spend 50 to acquire way more customers. How long is it going to take us for that to be profitable? And so I'd say really knowing those numbers of repurchase rate, what's your CAC, is really important. The other thing that I always ask and stumps people a lot, so I'd highly recommend knowing this, is what's your weeks of sale of your top performing inventory? In English, just what that means is it's dividing how many units do you have in stock versus how many units do you sell every single week of your, take your top 10 products. Do you have 2 months of inventory on sale where, you're going to sell through your inventory in 2 months, or do you have 2 years of inventory on hand? Why this matters is that's how much cash you just have sitting locked in a warehouse somewhere. And if you want to unlock more cash in your business, the fastest way is to unlock the cash out of your inventory. And so that's a data point that, there's no true benchmark for it. It kind of it fluctuates a lot based on your business, but could not, if somebody wants to optimize your business and get ready for a sale, really optimizing that where, you don't want to sell out ever, because that's not, you can't run a business if you don't have any inventory, but you also don't want to hold anything. And it's a great way to free up more cash in your business. And so I would say really focusing on not just your P&L, but those kind of metrics of how is the money flowing through your business, which you can pretty high level sum up with CAC payback, LTV or repurchase rate, and then your weeks of supply on hand.
Nice. Love it. Talk to me about Coco. Talk to me about Coco.ai. I know it's your first acquisition in this space, or with because maybe. It's a WhatsApp platform. Talk to me about that.
It is. So the great thing about creating content all the time is people will reach out to you and people will offer you great stuff and great deals. And yeah, this kind of just came out very fortuitously. The founders reached out to me late last year. Essentially what we're selling is, if you're familiar with an SMS platform in the States, nobody in Europe or Australia uses iMessage as their primary vehicle to talk to their friends and family. They use WhatsApp. So if you're in another platform, if you're in another country, you're not texting each other. They literally use it for their utility confirmation, or going to the hair salon or restaurant and getting your reservations at 6, but they're not texting their mom or their best friend. They're WhatsApping their mom and their best friend. And I was very, very involved about 5-6 years ago in the SMS space, and when that was very early. And I just saw the exact same thing emerge in WhatsApp. So we bought Coco, Shopify app. We're working with 625 customers, mostly internationally, but very heavily concentrated in Europe. And the goal is basically just to build Klaviyo for WhatsApp. So campaigns, automations. The one unique flair that we have is we've added an AI agent that can respond to the messages when customers respond. So common use case a lot of our customers have is abandoned cart message goes out. Hey, it's Marie from, Jeremy's hat brand. Do you have any questions? Is there anything I can help you with? Really customize, make it seem like Marie is reaching out from the brand. Customers will respond, ask, what's your shipping policy? Can I return this in 20 days? How does it fit? All those kind of components. And yeah, it's been great to see. We're seeing great results with brands just recapturing a lot more customers. And I'm very, very bullish just knowing, if you're running SMS in the States, you're probably looking at 15% of your revenue coming from SMS. And my big bet is that Europe and Australia are going to see the same thing over the next couple of years.
Very cool. Well, if people want to follow this, first of all, you got to go to, I mentioned letsbuyabiz.xyz. We'll put all of the links in the show notes. Follow Jeremy as well on LinkedIn. And because.ventures, if you're out there looking to talk to someone about any of this stuff, you're obviously a wealth of information. Thanks for coming on the podcast today. This was awesome.
Yeah, really appreciate the time, Eric. If there's anything I can help with, just reach out on LinkedIn. Happy to help.